There is a fund sitting in your brokerage right now that has quietly beaten the S&P 500 over every single historical period of 32 years or longer, without one exception. And the overwhelming majority of people building dividend portfolios have never put a single dollar into it. And I get why. Because when most people hear real estate investing, they picture a landlord dealing with a broken furnace at 11 p.m., or they picture needing $50,000 to put a down payment on a rental property. So they skip the whole category entirely. But what I'm going to show you today is that you can own a fractional piece of thousands of commercial buildings, cell towers, and data centers for about $1 to start, and have it throw off income every single quarter without ever talking to a tenant. This video is about REITs. Specifically, what they actually are, why the income they pay you works completely differently from a regular stock dividend, and then we're going to run the math. $200 a month, your actual numbers, what it becomes over time. I've done this kind of math before on dividend stocks, and I've done it on index funds, but REITs have never gotten their own video on this channel, and honestly, that's been a gap. So today we're filling it. And there's one more thing I want to get to before we're done. A tax change that happened on July 4th of this year that makes the REIT income significantly cheaper to own than it was even 6 months ago. And almost nobody making REIT content right now knows it happened. So stay with me because that part alone could change how you think about where to hold this. Let's start with what a REIT actually is, because the mechanics matter here. REIT stands for Real Estate Investment Trust. The basic idea is that a company goes out and buys income-producing real estate, office buildings, apartment complexes, warehouses, cell towers, self-storage facilities, data centers, and then it lets regular investors like you and me buy shares in that portfolio, just like buying stock. The difference is in how the money flows. A regular company like Apple or Coca-Cola pays you a dividend out of its after-tax profits, meaning the company already paid 21% corporate income tax on everything it earned, and then whatever's left over, they might share some of it with shareholders as a dividend. You then pay your own tax on top of that. 2 layers of tax on the same dollar. REITs are legally structured to skip that first layer entirely. By law, a REIT has to distribute at least 90% of its taxable income directly to shareholders, and because of that, it pays no corporate income tax at all. The money flows straight through to you. That's why REIT yields tend to look so much higher than regular stock dividends. It's not magic, it's just that there's no corporate tax taking a cut before the income reaches you. The trade-off is that because it's not a qualified dividend, you pay ordinary income tax rates on it, rather than the lower 15% dividend rate. But here's where that July 4th update comes in. There's a deduction called Section 199A, and as of this year, it's been made permanent. What it does is let you deduct 20% of your REIT dividend income before calculating what you owe. So if you're in the 22% tax bracket and you receive $4,572 in REIT distributions in a year, you get to knock 20% off that number first. Your actual taxable REIT income drops to $3,658, and your effective tax rate on those distributions comes out to about 17.6%. Compare that to the 15% qualified dividend rate on regular stocks, and the gap is literally $118 a year on the same income. That's nothing. And in a Roth IRA, you pay zero either way. The reason this matters so much is that this deduction was set to expire at the end of 2025. That created 7 years of planning uncertainty for anyone trying to build a long-term position in REITs. That uncertainty is gone now. You can plan around 17.6% as a permanent rate, and virtually every piece of REIT content made before July 2025 is missing this entirely. But before we get to the actual numbers, and we will get there, I want to address the elephant in the room, because if you've looked at VNQ recently, you've probably noticed something uncomfortable. Over the past 5 years, VNQ gained about 2.6%, while the S&P 500 was up around 85%. And if you saw that and thought, well, REITs are broken, I completely understand. But there's a specific reason for that underperformance, and it's not structural. Starting in March 2022, the Fed went on the most aggressive rate hiking campaign in decades, and REITs got crushed by that, not because the properties stopped generating income, but because higher rates make property financing more expensive, compress valuations, and suddenly make treasury bonds competitive with REIT yields. It was a brutal environment for the category. Goldman Sachs is currently projecting 2 more rate cuts in 2026, bringing the federal funds rate down to somewhere around 3% to 3.25%. Lower rates mean cheaper debt for property acquisition, better valuations, and less competition from bonds. The headwind that hammered REITs for 3 years is actively reversing, and you're looking at a chance to buy into this category at prices that reflect the worst rate environment in a generation right as that environment is changing. That's important on its own. But here's the longer-term picture that I think is the real story. From 1972 to 2024, that's 52 years of actual data, the FTSE Nareit All Equity REITs Index returned 12.6% annualized. The S&P 500 over that same period returned 8.0%. And the research on this is specific. There has not been a single historical period of 32 years or longer where stocks outpaced REITs. Not one. And REIT outperformance gets stronger the longer the time horizon gets. It shows up in more than 90% of all historical periods longer than 24 years. If you're 45 right now with a 20-year runway, you are sitting in exactly the time horizon where REITs go from being an underdog to being a structural winner. That's not a motivational statement, that's what the data shows. So let's run the numbers. The fund I'm going to use here is VNQ, Vanguard Real Estate ETF. It holds over 150 REITs in one fund. It's got a 0.13% expense ratio, which is extremely cheap. It yields 3.86% right now, and its since inception average annual return is 7.45%. For the math I'm about to show you, I'm going to use 8%. That's right in line with VNQ's own history and well below the 52-year Nareit benchmark. It's a conservative, defensible number. Now, $200 a month. I want to address that number for a second before we go further because I know how it sounds. If you're at the 22% tax bracket, you're not actually giving up $200 out of your take-home pay. You're giving up about $156 because that $200 of earnings would have been taxed anyway. The question is never really, can I afford $200? It's, can I afford $156 a month? That reframe matters. So, $200 a month into VNQ at 8% annual return. In 10 years, you've put in $24,000, and that position is worth about $36,590. That's already $12,000 more than you put in, just from compounding. At 15 years, you've contributed $36,000, and the portfolio is worth around $69,080. At 20 years, $48,000 contributed, and the portfolio is worth approximately $117,800. But here's the part I want you to actually sit with, because this is where REITs do something that a pure growth fund doesn't do in the same way. At year 20, that $117,800 portfolio at VNQ's current 3.86% yield is throwing off about $381 a month in distributions. Every quarter, money is hitting your account. You started by putting in $200 a month. 20 years later, the portfolio is paying you back $381 a month, nearly double your original contribution, and you still own the whole position. That's the income layer working on top of the growth layer simultaneously. And if you want to use the actual 52-year historical rate of 12.6% instead of the conservative 8%, at 20 years, $200 a month becomes roughly $228,500. That's close to $250,000 from $48,000 in contributions. Now there's one more thing I want to cover that almost nobody explains clearly, and it's called return of capital. Some of the distributions a REIT pays you aren't technically income. They're a return of your original investment. This sounds alarming, but it's actually fine. Return of capital is not taxed when you receive it. Instead, it just reduces your cost basis. So if you bought 100 shares at $50 each and the REIT returned $6 per share in ROC over a few years, your new cost basis is $44 per share. You only deal with the tax implications when you eventually sell. The practical effect in the short term is that a portion of what looks like income on your statement creates zero tax liability that year. It's essentially a tax deferral built into the structure. Okay, so here's how you actually do this. You open a brokerage account if you don't already have one. Fidelity, Schwab, or Vanguard all work fine. You search the ticker VNQ. You set up an automatic recurring investment of $200 a month. That's it. You don't pick properties, you don't deal with tenants, you don't arrange financing, you don't pay property taxes, you own a fractional claim on data centers, cell towers, warehouses, apartment complexes, and self-storage facilities across the country, and you collect your quarterly distributions while doing nothing. On the account type question, and this is the nuance I mentioned earlier, if you hold VNQ in a Roth IRA, your distributions grow completely tax-free, which is great. But you also give up the 199A deduction, because that only applies in a taxable account. For most people in the 22% bracket, the math on a taxable account works out to an effective rate of 17.6%, which is close enough to the Roth benefit that it's worth considering, especially if your Roth is already being used for other holdings. If you're in a higher bracket, the Roth advantage gets bigger. If you're in the 22% bracket or below, a taxable account with a 199A deduction is genuinely competitive. If you've been building a dividend portfolio on this channel, dividend ETFs, maybe some individual dividend stocks, REITs slot in as a third pillar alongside those. They behave differently from traditional equities. They have lower volatility over long periods. The standard deviation on 20-year REIT returns is 6%, compared to 13.8% for U.S. stocks. And they add a real estate income stream that isn't correlated to corporate earnings in the same way your other holdings are. If you want to see how this fits with the dividend ETF side of the portfolio, I've got a video on that right here. It covers the same recurring contribution math applied to dividend-focused funds, and the two strategies complement each other well. Here's where we started. REITs sounded like either a landlord headache or a category that got crushed in 2022 and never recovered. Here's where we ended up. It's a legal pass-through structure that skips corporate tax, distributes income directly to you at an effective rate of 17.6%, thanks to a now permanent deduction, has beaten the S&P 500 over every 32-year-plus historical window in recorded data, and you can own all of it for $1 and 0.13% per year in fees. $200 a month, $156 out of your actual take-home, 20 years, $117,800 and $381 a month in distributions, nearly double what you put in, every single month, from a portfolio you never had to manage. The one thing I want you to do right now is drop your age and your target retirement year in the comments. I read every single one of these, and I want to see what your 20-year number looks like. Because I think when you see your specific math written out, it changes how this feels, and that's the whole point.